Good afternoon, and welcome to this critical deep dive into the forces currently reshaping the U.S. financial landscape. We are opening the vault on the market movements of Thursday, October 9, 2025.
Good afternoon.
And it was quite a day, wasn't it? It didn't just move, it seemed to perfectly crystallize this contradictory tension investors are grappling with right now.
It really did. It was a day that I think demanded a cautious pause. Think about it.
Yeah.
Major indices, driven by sheer momentum, briefly touch fresh, really gravity-defying record highs.
Like it's the open.
Exactly. Only to, swiftly succumb to selling pressure and close the session in the red. Now, this wasn't a panic, let's be clear.
No, not a rout.
Not at all. This was consolidation. But we really have to examine what those powerful, conflicting forces were that caused that retreat. Because, frankly, they're still driving this market.
Absolutely. So our mission today is to unpack that conflict for you. We've got these two powerful engines operating simultaneously. On one side, you have this almost feverish, unprecedented enthusiasm for artificial intelligence.
It's undeniable.
Propelling infrastructure stocks like advanced micro devices and NVIDIA just into orbit. But then on the other side, we have this complete structural information vacuum.
Caused by the lingering U.S. government shutdown.
Right. And combined with that, you have these very real questions about whether these incredible valuations are actually sustainable.
And what's fundamentally fascinating here, I think, is that the market is running primarily on powerful, deeply entrenched narratives.
Beliefs, really.
Beliefs, exactly. The belief in technological transformation, this AI revolution, and the belief in forthcoming Federal Reserve easing. It's not running on current, comprehensive, verified government data because, we don't have it.
So we're talking about a market that is essentially walking a tightrope.
That's a good way to put it. Grappling with its own spectacular success and trying to figure out if this current trajectory is genuine economic metamorphosis or, maybe just a highly speculative peak.
Okay, let's start with the immediate action of the day then, that market reversal. You mentioned indices open at all-time highs only to close negative. It felt like the air suddenly thinned out right as they reached that peak.
It did. And it was a classic case of profit-taking mixed with some institutional risk management. It seemed triggered mostly by the lack of new positive catalysts.
Just ran out of steam.
Pretty much.
Yeah.
I mean, after such a dramatic run, remember the S&P 500 had snapped that 7-day winning streak just recently. The attempt to push through those record highs, it just failed to attract enough fresh buying volume.
But didn't collapse either.
No, and that's key. The micro-level good news, especially those robust corporate earnings reports we'll definitely get into later, provided a crucial supportive floor. It prevented a steeper decline.
So earnings saved the day to an extent.
To an extent.
Yeah.
But they couldn't overcome the generalized macroeconomic anxieties and, critically, the specific structural problem of this data void.
Okay, let's get granular then. Let's look at those specific closing numbers because they tell us exactly where the market was feeling the stress. The S&P 500, the broadest index, arguably the most representative, it fell 19.77 points. That's 0.29%, closing at 6,733.95. Pretty modest, almost symbolic decline.
Modest, yes. But now, look at the Dow Jones Industrial Average. This is where the retreat was really most pronounced. The Dow shed 193.35 points.
A bigger percentage drop.
Exactly, a 0.42% decline, closing at 46,408.43. And the size of that drop in the Dow relative to the S&P, that's a vital clue.
Why is that?
Well, the Dow is price-weighted, remember, and it tends to contain a heavier concentration of traditional blue-chip cyclical industrial names.
So is the Dow's more pronounced drop really just about these cyclical names feeling the pressure, or is there maybe a component of passive index investing flows driving some rotational selling?
Sometimes the simplest explanation isn't the whole story. That's a sharp question. And you're right, it's probably a mix. While cyclical names are definitely the most sensitive to economic uncertainty, and their weakness certainly suggests anxiety about the durability of this expansion.
Especially with no data.
Especially with no data. We absolutely saw institutional portfolio managers recalibrating their exposure after that 7-day run-up. The rotation wasn't random, though. It felt strategic.
How so?
The selling was concentrated in areas perceived to have maybe limited immediate upside, which often means those large-cap industrials that perhaps led previous phases of the recovery. The selling wasn't necessarily driven by a deep conviction of recession, I don't think.
More like trimming risk.
More like a strategic choice to reduce exposure to economically sensitive sectors when reliable economic metrics just weren't available. It's prudent risk management in a vacuum.
Okay, now contrast that with the tech-heavy NASDAQ composite. Even with this broader pullback, it had the mildest retreat. It lost 75.80 points, just 0.33%, closing at 22,967.58. It seems to have this, I don't know, built-in resilience right now.
And that resilience, that points directly back to the persistent AI anomaly we mentioned. If we zoom in on the sector activity for the day, we see a fascinating and, frankly, very telling, nuanced risk-off sentiment.
Nuanced risk-off, meaning?
Meaning capital wasn't fleeing the market entirely, not by a long shot, but it was rotating almost with surgical precision into perceived safety or into those unstoppable growth narratives.
Okay, let's unpack that sector rotation. Where did the money go for safety? Where were the winners?
Right, the outperformers, sectors that actually closed positive, were classic, defensive, or essential plays, consumer staples and energy.
Staples make sense. People always need toothpaste and soda.
Exactly. And consumer staples were significantly buoyed by those very strong earnings results from PepsiCo, a quintessential essential goods producer. It tells you that when investors get nervous about the broad economy, they prioritize companies making necessary, non-deferrable products, the soda, the chips, the household stuff.
So stability trumps high beta growth when the data dries up? Predictable.
Precisely. Energy also performed well. It often acts as a hedge against global instability and those persistent inflation concerns, both of which are very real factors right now.
Okay. And the losers. Where did the money come from?
Well, the weakest links were the highly cyclical sectors, consumer discretionary and industrials. These are the companies that really rely on consumers feeling confident enough to buy new cars, luxury items, or large capital equipment for businesses.
Things you can put off?
Exactly. Their weakness suggests a combination of profit-taking after the run-up, coupled with a genuine anxiety about how long this current high-spending environment can actually last, especially without fresh, reassuring government reports to back it up.
But the real star, or maybe the real anomaly here, is the semiconductor sector. Despite the broader retreat, the PHLX semiconductor index, the SOX,
The SOX.
remained this conspicuous pocket of strength. It had just hit fresh all-time highs the day before on Wednesday.
And this is the definitive evidence, I think, that the AI theme is currently operating almost entirely independently of broader economic and political concerns. It's like it's in a parallel investment universe.
Shielded somehow.
Effectively shielded, yeah. Shielded by the sheer scale of anticipated capital expenditure. It feels like, regardless of inflation readings, shutdown impacts, or geopolitical flare-ups, the market is utterly convinced that the AI build out this massive foundational infrastructure requiring cutting-edge chips must continue.
No matter what.
No matter what. So the companies providing those fundamental components, they're viewed almost as non-negotiable investments right now. And that cements the SOX's resilience even when the rest of the market decides to take a breather.
So the market might be consolidating, taking that breather, but its overall direction seems dictated by these three incredibly dominant and often conflicting narratives. Let's dive into narrative one, the massive AI euphoria and the corresponding correction risk.
Right. This narrative provides the momentum, the excitement, and also that palpable tension we talked about. I mean, the pace and scale of the move in AI-related stocks are just extraordinary. This isn't just a bull run anymore. It feels like a structural re-rating of entire segments of the economy based on future potential.
And we see that in the numbers, absolutely. Look at Advanced Micro Devices, AMD. It rallied approximately 45%.
45%.
In October alone. And this colossal surge wasn't just fueled by general enthusiasm, right? It was driven by concrete operational news, that high-profile deal with OpenAI.
Big news.
And an immediate flurry of positive Wall Street analyst upgrades following that. It indicates that the institutional conviction in this AI ecosystem is incredibly high right now.
And you can't forget the foundational pillars here. NVIDIA, obviously the undisputed leader, and Dell Technologies, which has been demonstrating massive upside potential in its AI server commentary lately.
They're the picks and shovels.
They are the picks and shovels for this new gold rush. Exactly. The market isn't just buying growth. It's buying inevitability. It's the belief that this massive build-out of computing power must happen, regardless of the cost.
Okay, but here is where it gets really interesting, though. That sheer euphoria is now being met with an increasingly loud, high-profile chorus of skepticism. A tangible warning that maybe this momentum is, well, speculative froth.
Absolutely. And the warnings are coming from institutions and individuals that you really can't easily dismiss. Jamie Dimon, the CEO of JP Chase, stated publicly that the probability of a serious market correction is more like 30%.
Which sounds maybe not that high, but coming from him.
Right. 30% might not sound like a certainty, but when you consider how benign the market's current volatility index is, the VIX, a 30% chance of a serious correction, is actually a risk far higher than what current pricing models seem to reflect.
And he's not alone. We had the Bank of England just issuing a warning on Wednesday
That's the day before.
of a rising risk of a sudden correction in tech stock prices, and they explicitly cited the speed and concentration of the AI boom as the primary pump for that speculation.
So this creates a really unique and, frankly, agonizing tension for you as an investor. On one side, you have that paralyzing fear of missing out, the FOMO.
Huge FOMO.
And what many serious analysts believe will be the defining technological revolution of the next decade. But on the other side, you have the rational, structural fear of buying into a speculative peak. The kind of peak that, historically, precedes a massive, painful repricing.
Like 1999.
Exactly. The market is essentially trapped between these two compelling yet contradictory psychological forces. And it's all playing out at valuations we haven't really seen outside of the 1999 tech bubble.
Which makes the lack of clear economic sight lines doubly dangerous. Okay, let's move to narrative 2. The government shutdown and the data void. This is the structural issue in Washington that's just making every investment decision harder right now.
Yeah, this information blackout is really a crisis of clarity. The absence of critical, high-frequency economic reports deprives investors and, crucially, the Federal Reserve of that necessary real-time pulse of the economy.
And the big miss on Thursday was?
The single most crucial missing piece on Thursday was the weekly initial jobless claims report.
Okay, for those who might not follow it quite so closely, why are initial jobless claims such a vital gauge? What makes them so important week to week?
Well, because it's the most current, high-frequency, real-time indicator we have of labor market health. It tells us almost immediately how many people are losing their jobs each week. It's a very sensitive early warning signal for economic slowdown or potentially acceleration.
So without it,
the market is flying blind, basically relying on outdated monthly reports. You lose the ability to see those sudden labor market shifts that could signal a serious cooling or, conversely, continued overheating. And both of those outcomes radically alter the Fed's likely path.
Okay, so if the data is missing, what is the practical consequence? I mean, how does the market manage that risk? What does it latch onto instead?
Well, the blackout doesn't just create silence. It actually amplifies the importance of any sound we do hear. So corporate earnings reports, like the ones we saw from Delta Airlines or PepsiCo,
They become huge.
They're no longer just about the health of those specific companies. They're being intensely scrutinized and, frankly, extrapolated as vital, if imperfect, proxies for the state of the consumer and the broader economy.
Can you give us a concrete example of that extrapolation? How does that work in practice?
Certainly. Okay, take Delta. When Delta reports that robust summer travel demand is continuing into the fall, the market takes that single data point and uses it to justify the narrative that the high-end consumer is completely healthy, unaffected by inflation or rates.
So one airline's good news means the whole economy is fine.
Well, the market extrapolates that if people are still willing to pay high prices for flights and experiences, then consumer spending, generally, must remain strong enough to avoid a recession. Now, this is inherently risky, right? Because Delta's clientele isn't necessarily representative of the broader population, maybe the part that's struggling more.
Of course.
But in a data vacuum, it's the best information available. So every piece of micro-level corporate news becomes like a temporary oracle.
The market just grasps onto these fragments, trying desperately to justify those record high valuation levels?
Exactly right. The narrative dictates the data interpretation rather than the other way around, which is usually how it should work.
And that brings us nicely to narrative 3, the Fed's calculated silence. Fed Chairman Jerome Powell was scheduled to speak on Thursday, and the entire financial world was basically holding its breath, waiting for the slightest hint, the smallest nuance regarding future rate policy.
And the outcome was extremely telling, precisely because of what was not said. Powell's prepared remarks deliberately, and I mean deliberately, omitted any discussion on monetary policy.
Zero mention.
Zero mention. This silence was not an accident. It was clearly a highly calculated strategic move. It seemed designed not to inject unnecessary volatility or ambiguity into an already volatile, data-starved environment.
But the market craves clarity. Does his silence suggest maybe he's worried about the economy, or is he simply allowing the existing consensus view to continue unchallenged?
I think it's the latter. It allows the existing consensus to persist unchallenged. The market is operating on a very specific baseline expectation right now, derived from previous FOMC minutes.
Which is?
That baseline is clear. Policymakers remain inclined to cut interest rates, likely due to expected disinflationary pressures down the road. Traders are currently pricing in a very high probability of 2 more 25 basis point rate cuts before the end of 2025.
So Powell saying nothing actually reinforces that?
In effect, yes. Powell's silence on Thursday essentially reinforced the status quo belief that all-important Fed will pivot narrative, which provides continued support for risk assets like stocks. If he had given even a hint of hawkishness, suggesting rates might stay higher for longer,
The market would have tanked.
it would have recoiled immediately.
Mm-hmm.
So his quietude was actually a kind of dovish signal by omission.
Okay, so if the equity market is wrestling with AI momentum and this data deprivation, the macroeconomic indicators are painting a profoundly complex and frankly contradictory picture of global investor fear. We need to talk about what I think is the real aha moment of the entire week, the gold dollar anomaly.
Oh, absolutely. This is hands down the most striking and unusual development in the macrosphere right now. As you said, gold and the U.S. dollar are traditionally inverse assets. They usually move in opposite directions.
Right. Dollar up, gold down.
Typically, when the dollar index, the DXY, which measures the dollar's strength against a basket of 6 major global currencies, rallies, gold, which is priced in dollars globally, typically weakens, and vice versa. They're opposing hedges, normally.
But on Thursday, we saw them both rallying simultaneously, strongly, even setting new records in gold's case. How on earth do you square that circle? What does that mean?
It's a spectacular display of fear and hedging, really. Let's look at gold first. Gold futures continue their stellar run, pushing comfortably past that historic $4,000 per ounce threshold earlier in the week.
Incredible level.
Incredible. And this surge seems driven by 3 key factors. 1, persistent, sticky inflation that isn't going away as fast as hoped. 2, rising geopolitical instability, which always helps gold. And 3, the debasement trade.
Okay, let's elaborate on that term, the debasement trade. What are investors truly fearing when they buy gold for debasement reasons?
The debasement trade reflects a deep-seated fear that massive government deficit spending and all this accumulated debt will eventually force the government, and by extension the central bank, to either allow inflation to run persistently high or, in a more extreme scenario, to intentionally weaken the currency to inflate away the debt burden.
Printing money, essentially.
Essentially. Investors see gold as a finite hard asset, a timeless store of value that cannot be printed or debased by fiat policy decisions. So they are using gold as a shield against long-term dollar deterioration and perceived financial mismanagement by governments.
Okay, so they are worried about the long-term integrity of the dollar. Makes sense for buying gold. Yet simultaneously, the DXY, the dollar index itself, staged a powerful rally. The dollar is gaining ground on its major rivals like the euro and yen. Why would capital be running to the dollar as the ultimate safe haven if they are also worried about its long-term integrity? That's the paradox.
This is the core paradox, exactly. And it's critical for you to understand this mechanism because it tells us investors are not making a single unified, coherent bet on the future. Instead, they are positioning what we often call a barbell of fear.
A barbell of fear. Explain that.
They are strategically hedging against 2 extreme and contradictory outcomes at the exact same time.
Okay, describe that barbell. What's on either end?
Right. On one end of the barbell, you have the persistent inflation currency debasement scenario. That's the long-term systemic risk we just discussed. This scenario overwhelmingly favors gold. Gold performs best when central banks are printing money, governments are spending recklessly, leading to a loss of purchasing power in fiat currencies.
Got it. Gold for the slow debasement. And the other end, the dollar rally.
That represents the immediate, acute systemic shock scenario. This could be a sudden geopolitical escalation, a major bank failure triggering a liquidity crisis, or a sharp global recession that triggers widespread deleveraging and panic.
Flight to safety.
Exactly. In a true panic, every major global institution, corporation, and government still needs access to U.S. dollars. It remains the world's most liquid, most accepted reserve currency by far. Capital flows toward the dollar in a panic, not necessarily because of its perceived long-term strength, but because of its unparalleled liquidity and utility in an immediate crisis. So this extreme, short-term economic shock scenario overwhelmingly favors the dollar.
So buying both means?
The simultaneous rally of both assets suggests investors are basically preparing for any worst-case scenario, whether it's slow erosion or sudden collapse. It indicates the market's foundation might be far more fragile than those record-high equity indices suggest.
Wow, that is the ultimate expression of uncertainty, isn't it? And it's magnified exponentially by this government data vacuum. Now, how did the other key stability indicators react to all this macro drama? The bond market.
Yeah, in sharp contrast to the spectacle in gold and the dollar, the Treasury market remained relatively placid, almost eerily calm. The yield on the benchmark 10-year Treasury note held pretty steady, hovering right around 4.14%.
What does that tell us?
It suggests bond investors, traditionally the cautious money, are in a deep holding pattern. They seem unwilling to make any dramatic bets on duration or the direction of rates until the government shutdown is resolved and they get that crucial accumulated economic data back. They're essentially waiting for the clarity necessary to justify pushing yields significantly one way or the other. Just waiting.
Okay. And the VIX, the market's so-called fear gauge, did that spike?
Not really. The SIBO volatility index, the VIX, it ticks slightly higher to 16.39, but context is vital here.
16 isn't panic territory?
Not at all. Okay. While a VIX reading above, say, 20 often signals genuine fear, and readings above 30 usually signal real panic, a reading in the low 16s signals pronounced caution and uncertainty, definitely. But not widespread panic or capitulation. Investors are not selling everything indiscriminately.
They're hedging, rotating, waiting.
Precisely. The low VIX confirms that the dominant psychology, despite the gold-dollar move, is still driven by optimism. The AI story, the Fed pivot hope, that outweighs the palpable fear reflected in that barbell trade, at least for now.
All right, since we are operating in this peculiar data vacuum, as you said, the micro-level corporate earnings reports have taken on this outsized importance. They're the market's temporary oracles. So let's look at the earnings beats that provided that supportive floor for the market on Thursday, the micro-level strengths fighting back against the macro uncertainty.
Right. Delta Airlines, ticker DAL, was a real standout performer, soaring 5.2% on the day. They reported earnings per share of $1.71, which handsomely beat the $1.52 consensus estimate.
Nice beat.
It was. And this was a critical piece of data because it wasn't just a beat, it contained a narrative.
What narrative was that? Travel's back.
The narrative of the resilient high-end consumer. Delta's strong results were driven by robust summer travel demand that, importantly, they said, has successfully sustained its momentum into the current quarter. People are still willing to pay high prices for premium travel experiences.
And that lifted other airlines, too.
It did. That optimism created an immediate and strong tailwind for the entire airline sector. You saw United Airlines climb 5% and Southwest Airlines rise 2% just in sympathy. This signal is powerful for the market right now. It interprets this as evidence that inflation has not yet seriously curtailed discretionary spending among key consumer demographics.
Okay. And the essential goods consumer bellwether PepsiCo, ticker PEP, also delivered some important news.
Yes, PE gained 3.5% after topping forecasts. They posted an EPS of $2.29 versus the $2.27 expectation, so a smaller beat, but still positive. The key detail in the report was a significant improved momentum in their North American beverage business.
So drinks are doing well.
Drinks are doing well. This managed to offset some ongoing struggles in their Frito-Lay snack division, interestingly. But it demonstrated that even these staple companies are finding pricing power and efficiency gains to pass on to the bottom line, despite broad inflationary pressures on their own input costs.
Okay, and what about the physical retailer side? Costco. Always a good read on the consumer's willingness to spend in bulk.
Right. Costco, wholesale, Co-ST, rose 2.2%. That came after they announced that their sales for the month of September actually exceeded Wall Street forecasts. Again, this is seen as a strong, tangible signal of resilient consumer spending.
People still flocking to the warehouses?
Apparently so. Consumers are still visiting the warehouses, they're still making large bulk purchases, and they are not dramatically pulling back, even as interest rates remain elevated. So these three corporate beats, Delta, PepsiCo, and Costco, they were really the primary forces justifying the market's overall high level yesterday, acting as anchors against that macroeconomic anxiety.
And the AI continuation narrative, that got reaffirmed after the closing bell too, right?
Absolutely. After hours, both AMD and NVIDIA continued to show positive momentum. AMD was up about 1.42% and NVDA up 1.25% in late trading. This just demonstrates that the narrative inertia surrounding AI is so powerful that even a day of market consolidation can't easily dislodge it.
The believers are holding strong.
It seems so. The institutional money clearly views these stocks as a secular growth story. largely separate from any short-term economic hiccups.
However, not all the corporate news was bullish yesterday. Let's turn to the notable declines, where we definitely saw risks and some significant profit-taking surface. Ferrari, ticker ARACE, saw a brutal plunge.
Oh, brutal is the word. Ferrari shares plummeted a staggering 15.4% during the session.
15%, what happened?
This dramatic, almost punitive sell-off was triggered by a guidance update that severely disappointed investors. Look, when you are a luxury automaker trading at an extremely high valuation premium like Ferrari does,
Expectations are sky high.
exactly, any hint of uncertainty about future growth prospects or delivery guidance gets severely penalized. The market's tolerance for disappointment in these premium growth stories is currently near zero. It suggests investors are incredibly quick to lock in profits if the path ahead looks even slightly cloudy.
Got it. And Tesla, TSLA was another heavyweight, falling 1.6%. What was the news there?
That decline was directly linked to a negative Reuters report. It stated that the National Highway Traffic Safety Administration, NHTSA, has opened a preliminary evaluation into nearly 2.9 million of its vehicles. This probe is focused on safety concerns and reported traffic violations related to the Full Self-Driving System, or FSD.
That sounds serious.
Regulatory scrutiny of this magnitude always creates a major overhang for a stock like Tesla. It raises the prospect of potential recalls, maybe litigation costs, and certainly delays in deploying the core technology that really underpins so much of stock's aggressive growth narrative. It just shows that even powerful narratives are vulnerable to regulatory risk.
True. And finally, Dell Technologies, DEL. It had enjoyed that massive, almost speculative surge earlier in the week tied to its AI server commentary.
Huge run-up.
But it sank 5.5% on Thursday, profit-taking.
That looked like the clearest example of classic profit-taking all day. When a stock runs up that far, that fast, sometimes based more on commentary and potential rather than confirmed, booked revenue figures. A significant portion of investors are just ready to cash out their gains at the first sign of broader market weakness.
Locking it in.
Locking it in, it's a necessary cleansing process in any big rally, really.
Yeah.
The quick money exits, leaving the longer-term investors, hopefully, to hold the line.
Okay, moving briefly to after-hours activity then. What set the tone for Friday's session? Anything stand out, showing us where the immediate focus lies?
Well, the focus remains squarely on those micro-catalysts, the individual company stories. Applied Digital, APLD, which is a key infrastructure stock benefiting from the AI theme, managed a modest gain after hours, about 1.5%. Levi Strauss, LEVI, was slightly down after its report.
But the big mover was.
The real story, after hours, was Keysight Technologies, KYS. It was the top after-hours gainer, soaring nearly 11% on strong, stock-specific news related to its own business.
Wow, 11%.
Yeah. And this just reiterates that core theme we've been hitting. When the macro data is absent, these micro-level stock-specific catalysts, like earnings or company news, they completely dominate sentiment and dictate the immediate trading direction.
Okay, let's try and synthesize this wild day of conflicting signals then. The main conclusion we seem to be drawing is that the market is operating in this state of narrative inertia. It's running on deeply entrenched belief.
That's right.
The belief in the inexorable AI transformation and the belief in forthcoming Fed easing, it's running on that rather than on verified, comprehensive reality from Washington, because that reality is currently missing.
And that narrative support is absolutely critical right now, because it's the primary force currently justifying these near-record high equity prices. We see positive earnings reports from a relatively small, self-selecting sample of companies like Delta and Costco being readily absorbed as conclusive evidence of underlying economic resilience.
Confirmation bias, almost.
It has that feel. But this heavy reliance on belief, rather than data, creates a profound and, I think, urgent vulnerability for every investor right now.
Which is the double-edged sword of the data void you mentioned earlier?
Exactly. The vulnerability lies in the simple fact that this belief is currently untested by hard, broad economic data. When the government shutdown finally ends, and presumably it will end eventually, the subsequent flow of accumulated employment data, inflation numbers, retail sales figures, all that data will be restored.
And the risk is?
The risk is that that data could very easily and potentially violently contradict the optimistic prevailing market assumptions. If the accumulated employment figures or the backlog of inflation reads come in significantly worse or even significantly hotter than the market has optimistically priced in,
Look out below.
it could trigger a sharp, rapid, and potentially very severe market repricing. It would force a sudden, nasty clash between the comfortable narrative and the uncomfortable reality.
Okay, that is definitely the risk we need to prepare for. So for our listener, navigating this tricky period, what are the 4 key signposts they absolutely must watch over the next week or two to prepare for this potential collision between belief and data?
Okay, 4 key things to watch. First, pay very close attention to consumer sentiment. Friday's preliminary University of Michigan consumer sentiment report for October becomes critical, especially in this data vacuum. It will give us the best available timely read on consumer inflation expectations, which we know the Fed watches with intense scrutiny.
What are we looking for there?
Any unexpected jump in inflation expectations could immediately challenge that crucial rate cut narrative. That's number 1.
Okay, signpost 2.
Signpost 2, the official launch of corporate earnings season. The critical Q3 earnings season really kicks off next week with the major U.S. banks. You've got JP Chase, Wells Fargo, Citigroup, Bank of America. They're all reporting on October 14th, next Tuesday.
Why are the banks so crucial right now?
Because these institutions are the vital arteries of the U.S. financial system. Their reports, their commentary, will provide the first truly comprehensive health check on the financial system itself, on loan performance, credit losses, and broader economic activity from their perspective. We need to hear if their corporate executives are still optimistic about the final quarter of the year.
Got it. Number 3.
Third, focus intensely on the AI CapEx cycle. This AI narrative needs to move beyond just euphoria and into operational reality. We need confirmation that the massive capital expenditure, the CapEx, related to building out AI infrastructure is actually sustainable at these projected levels.
Is there a risk it might slow down?
There are credible expectations among some analysts that AI-related CapEx might actually peak sometime in the third quarter of 2025. So you must watch carefully for any forward-looking guidance from the key players. Think NVIDIA, AMD, or their major cloud provider customers like Microsoft, Google, Amazon, that suggests a slowdown or even just a peak in capital deployment.
Because that would hit the stocks hard.
That would be a powerful, perhaps devastating catalyst for a sector-wide correction in those high-flying AI names. And finally, signpost 4.
The obvious one.
The obvious one. The eventual resolution in Washington. We've established that the return of vital economic data is a double-edged sword. It removes the uncertainty of the information void, which is positive for planning, but it introduces the serious risk that the accumulated data turns out to be significantly worse than the market currently anticipates.
So brace for impact when the data returns.
Investors need to be prepared for the possibility that the first batch of restored government data could completely redefine the market's trajectory almost overnight. Hashtag outro. Looking back, Thursday, October 9th, 2025, might well be studied as the day the market plays that perfect barbell of fear, simultaneously buying the ultimate inflation hedge with gold and the ultimate crisis hedge with the U.S. dollar.
Yeah, the paradox is just profound. Hedging against persistent inflation while also hedging against a total global shock. This market is truly holding its breath, running almost entirely on these untested narratives right now.
And the vulnerability, as we've discussed, lies squarely in the market's firm conviction that those Fed rate cuts are inevitable. It's a conviction that is currently being reinforced by the conspicuous absence of contradictory data.
Which leads us directly to our final provocative thought for you, the listener, to consider. Given the market's near complete reliance on this narrative of Fed rate cuts, what is the single piece of missing economic data? Maybe it's initial jobless claims. Maybe it's the producer price index. Perhaps it's that consumer sentiment reading. What single piece, if restored and revealed tomorrow, would be most likely to first challenge that powerful belief?
Yeah, what specific data point holds the power to potentially shatter the AI bull run's core assumption of low future interest rates? Which one would hurt the most?
Something to definitely mull over as you navigate the coming weeks. Thank you so much for joining us for this deep dive into the complex crossroads of the U.S. markets.